our meetings today and tomorrow. Also to staff, obviously, for organizing the offsite, which I know can be complicated. So I think everybody's excited just to move the locations around so we have more participation from the regions we represent. So the first item is approval of the minutes for the November 14th Audit and Finance meeting held in Fort Myers. Can I have a motion for that?
I'll make a motion, please.
Thank you. A second.
Second.
Thank you. And all in favor, say aye.
Aye.
And against, we have consensus, so that passes. Next, I will call Ms. Weinberg for item 3, please.
Good morning.
Morning.
I will give a brief wrap-up of how we ended fiscal year 2019, and then continue with our performance in the first quarter of 2020. And then I will also discuss our strategy moving forward, so feel free to stop me if you have any questions or comments on anything. Just to wrap up, I've mentioned this before, but we comply with Florida Statute 218.415, which is local government investment policies. And as mentioned before several times, our safety, liquidity, preservation of principal is our primary goal. Yield is always last, but we try to invest any additional money safely and prudently per policy, because we don't want to leave money on the table. Our operating account only yields 1%, so we want to earn better than that. Our last policy was updated and approved in August of 2019, and this included our financial advisor, PFM's, changes to increase our mortgage-backed security allocation from 30% to 50%, and that adds flexibility to our investments. This change also brought the investment policy current, and it aligns with industry guidelines as well as GFOA best practices. I want to go over a few risk components that we deal with and how we mitigate these risks. We mostly invest in U.S. agency securities and mortgage-backed securities. One of the risks in investments is principal risk, but we have low principal risk because we're fully backed and sponsored by the U.S. government. We invest only in Ginnie Mae, Freddie Mac, Fannie Mae, and Federal Home Loan Bank. We have a low prepayment risk, which includes contraction and extension risk. When I purchase a bond, my brokers run their analytics, so I know when how long that bond is until maturity. So because we invest in senior tranches, all AAA, and short term as well, we know when we're going to get that money back. So it's low prepayment risk. We also have low interest rate risk because, again, the duration on our overall portfolio is 3 years or less. And the longer, and that's time to maturity, and the longer you go out, obviously, there's more uncertainty with interest rates, especially now. We have low duration risk, again, because we're 3 years or less per our policy. Low credit risk, we don't own any subprime securities in our portfolio. And last, low liquidity risk because we can sell at any time. We're a buy and hold portfolio. We don't buy and sell. But if we do have to sell, there's an active market for everything that we invest in. The Fed increased rates 9 times in a row before they started decreasing rates in fiscal 19. They decreased 3 times, and the last time was on 10/30, and they cut the rates by 25 basis points, and we're now at 1.5 to 1.75% percentage. I've spoken to economists and brokers and traders, and everyone pretty much is of the same thought process that they don't foresee any future cuts, and if they do, it won't be until later in the year. As rates go down, our callable agencies do get called, and that's why we diversify. I do 3-month lockouts, 6-month lockouts, one-year lockouts, and that gives us protection. We're basically selling call options. So the longer that lockout, the more of protection we have from that being called by the issuer. But for that, the trade-off is we get a lower yield. Due to the rate decrease, we had 13 bonds called in the new fiscal year, and that's $130 million worth of bonds that we had called that we're reinvesting currently. We also had $238 million in ad valorem come in the new fiscal year. Additionally, we're invoicing DEP monthly now as opposed to quarterly, so that allows us to have more cash coming in. And the reason I'm explaining all this is to explain why we have a higher cash balance as of 12/31. Our investment strategy is the same as it's always been, to keep cash balances low, laddering out investments to mitigate or help mitigate any decrease in earnings due to any potential future rate cuts. We'll continue to optimize yield safely and within policy guidelines. Increasing the mortgage-backed securities to 50% will greatly help us in maintaining our expectations of earnings even with the lower rates. The DEP monthly invoicing as of the end of fiscal 19 greatly aided us because we typically, without that monthly invoicing, we don't have the funds because we don't have ad valorem coming in at that time to help fund operating expenses. Therefore, I have to pull from our money market accounts. But I did not have to do that at all in fiscal 19 because of that. Our 19 budgeted earnings were $6.1 million, and our actual earnings came in at $12 million. So that's almost double. And our FY20 budgeted earnings are $7.86 million, and we're conservatively estimating $12 million. But I will keep updating that number as I present. The next slide discusses interest rates, and as you can obviously see, rates have fallen from September 30th through December 31st, except for the 5-year Treasury. As of 12/31, it increased from 1.55 to 1.69. Now, I spoke with my brokers this morning. As of today, the 5-year Treasury is at 1.35%. Yesterday, it was at 1.38%, so it already fell 3 basis points. And we typically invest as a spread to Treasuries. And just to give you an idea of the difference between the yield between agencies and mortgage-backed securities, for example, a current 3-year no-call for 6 months agency bonds, so we get 6 months of protection, is at 1.80%. But a 5-year, 3-month no-call agency with 3-month protection is at 1.85%. So what that basically says is we're picking up 5 basis points for only 3-month protection. So it's really not that significant. Now, believe it or not, the coronavirus, I had to bring that up, is the reason that rates are plummeting. As of today, stocks are down 300 points. And the reason for that is because of flight to quality, because everyone's dumping stocks going into bonds, and there's an inverse relationship between price and yield in bonds. So as a lot of people go into bonds, price goes up, yields go down. So that's what we're seeing now. The current Treasury at the beginning of the year, beginning of January, was 1.85%, and it's now at 1.53%. So that's a pretty huge drop. And as of yesterday, it was 1.55, so it fell another 2 basis points. But again, after speaking with economists and brokers and traders, everyone says this is headline risk, this is just overreaction, it's overblown, and by February we should start seeing things get back to our new normal, given the rate cuts. But it should not be this low. Our current portfolio, this table shows our yield as well as percentage of portfolio per sector. Again, as you can see, we have a large cash balance in the operating account due to the $238 million in ad valorem we received in a very short amount of time, along with the $130 million in bonds called due to the Fed cuts. But we typically aim for 10 to 15% in our operating account, and we ended 9/30 with 9.4% in the operating account. So that's our goal again. And my 3/31 presentation will show a much higher percentage invested and a much lower cash balance. We typically aim for a 70% to 30% split between investments and cash equivalents. This next slide shows our benchmark and how we do compare to our benchmarks and other peers. We earned 1.17% on our cash and cash investments, and we beat the S&P benchmark by 17 basis points, which earned 1%. We beat the investment benchmark, investment benchmark, the Merrill Lynch 1 to 3-year Treasury Index, by 95 basis points. We earned 2.55% versus their 1.6%. South Florida Water Management District earned 1.94%, so we were ahead 61 basis points there. St. John's earned 1.72%. We were ahead by 83 basis points. Now, a quick explanation also, as you can see, our duration is a lot higher than theirs. We're at 2.70. They're at 1.91, 1.07, 1.65, so the duration is a lot less, a lot shorter. Therefore, their investments are lower yielding. They're also heavily into treasuries, so that explains the differences. This is a wrap-up of fiscal year-end 19. As I mentioned before, we ended with $12 million in earnings for the entire fiscal year, which is $5 million above budget. Our book yield was 2.22, and that includes both cash and investments. And we had 72% invested and 28% in cash and cash equivalents, which is where we want to be. And again, of this amount, 9.4% was in the operating account. At the time, as of 9/30, the size of the portfolio was $5.65.2 million. And again, our blended yield on cash and investments was 2.22%. And this last slide is a snapshot of the first quarter of fiscal 20. Our portfolio increased. It's at 757 now, 757 million. Our yield on investments only is 2.5%, and we earned 2.6 million thus far as of the first quarter of fiscal 20. The yield on both cash and investments is 1.68, and this is typically known as cash drag, and that's because we have the large cash balance at 1.17%, which again will be rectified as we start putting money to work. And by my 331 presentation, you'll see the numbers have flipped. We'll have the 70-some-odd percentage invested with the 20-some-odd percentage in cash and cash equivalents. And we will see most of this by my 331 quarterly update. And again, after speaking with my brokers this morning, these rates should be back to normal by February. January was not a good year for investments, or not a good month for investing, just because of this coronavirus and just the market overreacting. So we'll see much better rates in February, and we'll start putting all this money to work and start seeing our earnings go up. And does anybody have any questions on anything?
Please.
So does that mean that it's best to hold the cash for now until we get over this bump? Because the next couple of weeks, I think, will determine whether the situation with the virus is going to be much worse or under control. And once everyone feels like it's under control, then the rates will go back up, right? So isn't it a good idea to hold the cash for a while?
For a while, but because we've received so much in, so to sit on it at 1%, it's almost makes more sense to at least and that this is my strategy, to put some of it to work at least those higher yields, because 1%, we would just be leaving so much on the table. So I won't be putting all of it to work, but mostly like diversifying. So putting a good majority so we can at least start picking up the basis points. And of course, I'll do the research and see what's out there. My brokers send me information on a daily basis, and they only send me, obviously, what's per policy and what is of interest to us. And I'll start putting that money to work so we start seeing these yields go down, because my concern is if we wait too long, then we're just sitting at 1%. And that's no good either. So we kind of have to balance it out.
Got it.
I think, well, that's a good question too, but obviously we're holding things to maturity typically. So I think, we're not as exposed to the price movements as we are focused on the yield of these.
Yes, correct.
And well, we're still marking, but it's not, right, that's not the primary focus is the capital appreciation, obviously.
Right, that's paper gains and losses, so that's not really a huge concern, but our concern is income. And at this point, and it is a tough decision, because do you wait until rates go up to that perfect yield that we want to see, or do you just let it sit at 1% or 1.17%? And that's just so low. So I think it's just best to, and again, they always say diversify, ladder out, and slowly get into the market. And according to my brokers, in February, we'll start to see, even with the mortgages at 2.10, that's already 50 basis points higher than a similar agency on a 3-year. So already 2.10 is quite a bit higher than 1.17%. So I'm not saying put all of it right now, but start getting into the market and start putting that money to work, just so we can meet our earnings expectations for fiscal 20.
Jackie, any questions?
Can you just talk a little bit more about the coronavirus and how it, for people watching, and how it affects the markets, et cetera? I was just overseas. I do not have coronavirus, but it was really interesting because over there, I mean, it was like we were in Spain, and it was all over the news, of course, and there were thousands of tourists in Barcelona, and there were, I mean, almost everywhere, people were wearing masks.
Yes.
And it was very strange. And it was the first time I ever thought, wow, and I asked my husband, I said, isn't this like kind of ridiculous? And he said, not really, because this virus is not controlled. And I said, well, what does that mean? He said, well, most viruses that we know of, they're controlled, but this one isn't controlled yet. So this is, it's going to be like this until they feel like it's controlled. So I just think it's very interesting. And I'd appreciate if you could just kind of, has this ever happened before? And what would happen if it didn't get better?
Well, we've had headline risk before, where different things happened, like with the whole China trade war and things of that nature. There's different headline risks that happen to hit the markets, and it's typically just an overreaction on the side of the investors until they feel comfortable enough that everything isn't just going to fall apart. But that's the reason that they put money out, take money out of stocks and dump them and put them into agencies, because, or into treasuries or bonds in general, because bonds, although they don't make the same earnings as stocks do, at least you're going to get your principal back. And I don't know much about the coronavirus. I just know from what I've seen on videos, it's terrible. People are locked down, not allowed to leave. I've seen people just dropping dead in the street, and that's not something that we're used to seeing here in this country. Also, after speaking with a few people, from what I understand, it wouldn't get to that point here, and I think a lot of people understand that we kind of have, we have different regulations in this country than other countries do. So I think that, again, it's just headline risk. People watching the news, being scared, and just making a split-second decision, calling their brokers, going on E-Trade or whatever they do, and just reacting, which is actually the worst thing to do, because it will settle itself. And even before it settles itself, the funny thing is with investors, and it's very funny, because they start calming down even before everything is necessarily fixed and back to normal. It's what's in the newspapers. So if the newspapers keeps bringing it up and making a big deal of it, which it is a big deal, but then it will continue. But again, from from people who have a lot more knowledge about this than I do, and economists and brokers who get questioned on this every day. From their perspective, and they've seen this before, they're saying it should level out by February, even if there's no cure or antibiotic or whatever, that the rates will level out.
Right.
That's the information they gave me.
Yeah.
So, and we really don't know until we continue to go through the weeks, and we go through February and March, and we see. But I see the rates every day. So, but they've certainly dropped significantly in the last couple of weeks since the beginning of January.
And the last time I saw it like this was with the earthquake, tsunami, and meltdown of the nuclear power plant in Japan. For a couple of months, the market was really struck, but it does level out and come back in time.
It does. I think people calm down and they realize the world's not coming to an end, and okay, we feel more comfortable putting our monies back in. But it's just a split-second reaction to what's going on. That's why in the financial world we call it headline risk, because it's what they see in the paper.
Thanks. Well, clearly a big issue with tragic consequences,
Very.
too. Just a few notes, comments. Can you go to page 5? So
Investment strategy?
this is the page. If you could just have the record reflect or maybe adjust the wording so that it's clearer when we say allocation to 50%, that doesn't necessarily mean that we're allocating 50%. We have the flexibility
Yes.
to go up to that. We're currently at, in the other one.
We're pretty low now. We're still in the 20s just because we have so much in cash.
I think it's about 22% currently, and then we should expect, given
Yes.
that big cash component, that there should be some pro rata increases across all the across the holdings,
Absolutely.
inclusive of MBS.
We'll see agencies go high 30s, 40s, depending on what's available in the markets, and we'll see the mortgages back to 30, maybe 35. But you're correct. Just because we can go to 50 doesn't mean we will. With the agencies, we can go up to 80. I've never gone up to 80. I've always been in the 40%, because just because you can doesn't mean you should. It doesn't mean it's for the best of the district. We make decisions based on what's offered in the market and what is the biggest bang for our buck. Like the example I gave, why would you give up protection for 5 basis points? It's just certain things just don't make sense. So if the mortgages at the time, whatever they're going to be, because from what I was told to my brokers, in February, first week of February, first week of March, they're issuing new mortgages, and that's when I'll see the best yields, and that's when I'll compare it to what a comparable agency is, and see if it's worth taking that on, going into the mortgage versus the agency. So it's really like a case-by-case scenario.
Okay. No, I just wanted, if anybody questioned that, to reflect the fact that you have the flexibility to allocate from an asset allocation perspective up to 50%. And then on page, I think the benchmarks are on page 8. Is that right?
Yes, they are.
Good. Okay. Well, thank you for doing this, and also, obviously, this reflects the good work that you guys are doing in Treasury and managing the account. It's also a reminder of how difficult investors who are low risk, high liquidity, what the challenges they face. So. We're looking at some constraints, well-meaning constraints with regard to how we invest, given the cash requirements that we have for projects and operating costs. But certainly it seems like, given the challenges the team's doing well relative to index benchmarks, as well as peer. Question on this, though, do we know if the other districts just don't have the flexibility that we do to go out on duration as much?
Well, it's their policy. They can, just like we do, we can tweak our policy as we want with, if the governing board approves it. So I'm not sure exactly what their policies are, but I know I've spoken, and a lot of them are in treasuries. Most of them are put a lot of money in short term in treasuries. And I did speak with, I think it was Southwest, and they said they didn't have the expertise to invest in mortgages. They didn't understand them enough, so they just don't. But unfortunately, you leave a lot of money on the table by doing that when you put a lot of money in treasuries.
Well, thanks for squeezing as much out of the stones as you
I
possibly.
try.
Any other questions? Questions from the public? No. Okay. Thank you, Lucy. Appreciate
Okay,
it.
thank you, everyone.
Mr. Burns, 4A and 4B.
Okay, I have two audit reports. The first one here is on the audit of software licenses. Currently, the district has over 500 software titles that they manage, and when you factor in the various versions of those, it says it's up to over 1,500 software products that our IT Asset Management Bureau is responsible for ensuring that all of those are stolen machines in the network are properly licensed. The audit did not include programs developed in-house since those aren't subject to the license requirements. So the audit objective was to examine the processes for negotiating and executing the software license agreements, as well as determining that all the software used within the district that is purchased from legitimate vendors, that we have it properly accounted for, as well as we have proper licenses for those. Overall, we found the IT Bureau does have proper controls in place over the software that's on the network. And one of the key controls is that you have to have what's called an administrative right to be able to install software. And only a few people in the IT have that authority. And so that's how we control what gets installed on a district computer. And how do we test that control? We tried to install some software and make sure it told us you couldn't do it. So that's, one thing that I want to point out, a good news initiative is that the IT has worked at trying to reduce the software cost over the years. And several things they've done is, number one, making sure that looking at the licenses that we have, determining do we still need them or not. Are people still using them? And if not, then we reduce the licenses there. So they've saved over $400,000 with that. Looking at if there's a less expensive product that's available that'll do the same job, the software maintenance cost, as well as some early payment discounts. And so over about a 4-year period, they've managed to save about $950,000. We had a couple of recommendations. One is that the asset management team that's responsible for the software license, the procedures are not in writing, so if someone new had to come in and take over the job, it would be helpful to have those processes documented. And so that's the risk there. The other is that there's some manual steps that's used in this process of sweeping the network and determining what licenses are out there. And there's probably some software packages out there that could help automate these manual processes that would make it more efficient. And so we basically made those two audit recommendations, and management concurred with both of those. So with that, I'll take any questions.
Rosie, any public questions? Any questions from committee members? Okay. Can we call the approval for the audit of service licenses to vote, please?
I vote to approve.
I'll second it, please.
Thank you both. And all in favor?
Aye.
Aye. Vote passes unanimously. And the second audit.
Okay, this audit is an audit of a lock mining lease agreement that the district has with White Rock Quarry. Little background on this contract or lease agreement was actually entered into all the way back in 2006. It was initially a 10-year lease with 3 5-year extension options. It's a 192-acre tract of land, of district land. And the actual mining operations, however, did not commence until December of 2015. Here's a picture of showing the location of the mine as well as an area of what it looked like at the time Google took this picture. It's located really right at the intersection of where I-75 intersects with the Turnpike Homestead Extension. There's actually, for the entire parcel, there's actually 3 different owners. And if you look at the color-coded map there, the green areas is what the district owns, which is actually about 25% of it. And then TIF, which is the trustee for the Internal Improvement Trust Fund, which is under the DEP at the state, owns the gold areas. And then the rock mining company themselves owns the blue areas. So the district actually only owns about a quarter of it. And the agreement is a 3-way agreement between these 3 parties, and the royalty payments are allocated based upon the percentage of acreage owned that each person gets for that. Initially, when the agreement was executed back in 2006, the mining company paid $75,000 a year through February 2009, and then that bumped up to $125,000 thereafter until the mining began. Then it went to a royalty payment. Now, however, the royalty payments, those payments from 2009, those prior to the mining, those were credited against the royalty payments until that was all used up with royalty payments. It initially started out at 95 cents a ton, but there's also an escalator index in there that's tied to, it's called the Construction Sand, Gravel, and Crushed Stone Index. That is an index that is maintained by the Federal Department of Labor. So it had gone up to, like as of June 2018, it was $1.50. The agreement, however, says that it gives 2 options. Either it's based upon the lime rock sold during the year, or 90% of the tonnage that is actually extracted from the mine. However, there is really no way of actually effectively doing option A, because once the material is moved to the rock processing plant, it is actually commingled with material that they're concurrently mining out of other property that is in different mines. So, and there is no weighing or measuring of that. So that leaves us only with option B in this case. And that requires basically measuring the size of the hole to determine how much material has been extracted. Give you an idea, over the first 3 years in operation, it was almost $7 million. I think currently we're running them around $3 million a year. It'll fluctuate with basically the construction industry and the economy. Now, the lease agreement requires the mining company, WRQ, to submit a annual survey of the mine and also an accountant's report. So of course, the objective of this audit was determined is the amount of money that we're receiving, the proper amount. And the one thing that was a little different with this contract compared to a lot of district contracts, most of our district contracts have a boilerplate where there's an audit right in there to where we have the right to go in and audit anything related to the agreement. In this case, however, the agreement required WRQ to go and get their own engineering firm and accounting firm to provide their reports and assessments and provide those to us. So it didn't have the usual audit right.
Can I stop you and just
Yes.
ask you a clarification before you move on? Because I'll just lose it. Okay, so the lease allows us the right to perform an audit on site. And of course, they could audit it anytime they wanted. Are we relying on their audit reports, or are we also going in and doing our own audit?
Actually, your understanding was not correct. The problem is the agreement does not have that normal audit right in there
For us?
for us.
Okay,
But it does require them to hire firms, an accounting firm, an engineering firm, to go in and do their annual survey, audit, and provide those reports to us.
And Tim, I assume that's the same with DEP. They also do not have the audit right.
It's the same agreement because it's a three-way agreement,
Okay.
right? So let's see. So we reviewed the accountant's report, and overall, we basically were able to recalculate what numbers they came up with, and we were okay with the numbers. However, as in the accountant's report, it's all based upon the volumes and quantities that are in the engineer's report. And of course, the engineer reports basically says we have relied upon those numbers, but we make no representation as whether those numbers are, good or not, because obviously they don't have the expertise. That's an engineer's
so
expertise.
guys, hang on to this one statement, right? Because we'll come back to it.
Sure.
That we rely on something that when a report says we rely on this, but we can't verify it, and if it's wrong, we're held harmless. Those statements always bother me. You keep going.
Right. So based upon, we basically recalculated and came up with their same conclusions. We were able to go to the DOL's website and determine that the PPI numbers and the escalators were, and the pricing was okay. So we were all okay with that. But once again, that's based upon relying upon the quantities in the engineer's reports. And, but we did get the WRQ did provide us with the AutoCAD files, which we had a district engineer look at, and they were able to verify the quantities. Essentially, they go out and they use basically sonar equipment and so forth, and they measure the size as a whole. And the amount extracted will be the difference between what it was the last time they measured it and the new measurement. And that's how they come up with the number of yards that are extracted. And I'll come back to that one in a minute, but I just wanted to, there was one other issue where we noted they do an inventory adjustment, and cumulatively, this would amount to about $120,000. The agreement says that it's based upon what's extracted from the mine. So they pull it out of the hole, and it gets stacked on the side, and then it gets hauled to the processing plant from there. When we discussed it, there, however, was no provision in the agreement for an inventory adjustment. When we discussed it with WRQ management, it was their viewpoint that it's extracted when they move the material to the processing plant, not just pulled out of the hole and set on the side of the bank. Might be a reasonable explanation, but the the bottom line was that an inventory adjustment is really just a timing difference. Eventually, we will get paid for that. At some point, when the mine has totally been completely mined, that inventory number goes to zero, and you get paid for that. And as far as from a, so it's a cash flow. It's a delayed cash flow that'll come in later. And most likely, assuming that price per ton will likely increase over time, we'll likely get paid at a higher rate, so that kind of gives us kind of like a sort of an interest built in inflation.
And what's the life cycle expected of this site?
We asked them, they projected possibly about 10 years, but of course, it's all going to depend upon economic activity, because they basically mine based upon what the, what is needed and what the market.
All things being equal.
About 10 more years.
And it's been in operation for how long?
They've been mining for about 3-4 years now. They
So
started in 2015, so about 4 years now.
my numbers show that the next time the governing board votes on this lease will be 2021. The next time it comes back up for a vote to the governing board will be 2021.
Okay. So the bottom line is, we were okay with their explanation on the extraction and the fact that we'd eventually get paid for this. It was just a timing difference on the cash flow. Now going back to the engineering survey, is that because when we measure the size of the hole, you have to measure the volume, which is yards. But the pricing in the agreement is based upon tons. So you have to use a conversion factor between the weight and between the volume and the weight. So they provide us with, we asked them, how they came up with that conversion factor. They provide us with this engineering standard. It's called ASTM standard C29-29-09. The engineers are probably familiar with that. So we did check with our district internal staff, as well as we contacted a mine expert at DEP. They both confirmed that that was an appropriate standard to use in determining this conversion factor. And essentially, it's a process that's done in a lab. They have to take a sample every month. They take it to a lab, and they do whatever they do with this process, which you'd have to be an expert at that to know how they do it. But and essentially, the 1.3 is an average, because it will vary a little bit with each sample. So it's actually just an average of all those monthly amounts. They also provide us with information from like some of the surrounding ones that were not district properties, and that's adjacent to ours, and showing that it basically was about the same as what ours is, which you would expect being the same material in the same area. So this was, it would take someone with the expertise to be able to let us know whether this conversion factor is a good factor or not, and we really had no in-house expertise to do that. And what I did put in the report, and what we did do, is what I call a sensitivity analysis to show what is the impact if this is even off by a little bit. So for example, just a 1.4 versus 1.3 would have had about a $500,000 impact if it should have been 1.4 instead of 1.3, and possibly $3 million over the life of it. So this gives you a feeling for how important this factor is. Unfortunately, this is one that we were not able to actually provide any assurance on. I can't give you a conclusion on whether this 1.3 is a good number or not a good number. And so our one recommendation in the report was for management to consider whether getting some outside expertise and maybe doing a couple of these ourselves, or whether we can hire somebody with this expertise to go and accompany their people when they're doing these monthly tests, to determine whether the standard is being appropriately applied or not. So other than that, essentially this audit was, it's a formula, and it was going through and getting comfortable with every variable in that formula. this is the only one I can't tell you whether it's a good number or not. So with that, I'll take any questions.
So they started, is it okay if I?
Yeah, sure.
They started in 2010, is that right? Well,
2015, mine.
15, okay. So first, I think the district did a good job with this audit. I do have concerns, and I shared with you and I shared with staff that I have concerns about this very issue. I also think that it might be important for district, I don't know if we have the right to, but WRQ has hired an engineering firm to conduct that work for WRQ, which ultimately means that they are, and we're relying on their results. So have we audited, interacted with, do we have confidence and faith in Forden, Levy, and Skiles, Inc.? Do we know anything about them? Do we ever use them? Do we have confidence in the work they do?
Well, that's where it comes down to being independent. They've hired them, but you have to look at who they're working for, and who's paying the bill, and that's WRQ to do their services.
Yeah.
Now, hopefully, you'd hope there'd be independent and objective, but we can't.
But we're humans.
We're humans, and it's always that auditor skepticism.
Right, and so I told you when we went over this, I believe in the process of trust but verify. That doesn't mean that everybody is not trustworthy, but I believe that we're dealing with taxpayer money, so we verify. So my advice would be that we also look at that company just to make sure that there's someone that we would do business with. You know the process that we go through when we choose vendors to do business with. I would think that we would want to make sure that we had confidence in them. So they were hired for periods April 10th, 2016 through April 10th, 2018. Are we actually getting this information once a year?
Yes, we continue to get these once a year.
Okay.
And the payments, by the way, we actually get them quarterly. They give us an estimate each quarter, and then they do these at the end of the year, and then they true it up.
And I think it's very important that we hire somebody to verify that calculation for us, someone who has the background and the expertise and the experience. I think it matters. And then finally, my only other thing is, let's talk about page 2. So the contract was off by 10 acres. And that,
Can you flip to page 2, Tim, please?
I think she's talking about on the report. I don't think I have that on the slide, do I?
yeah, so on the report on page 2, it says that an audit that you performed in 2012 identified discrepancies in the number of acres owned by the district in the leased premises. The lease agreement indicated that the district's ownership percentage of 25.2 is based on parcels totaling 192 acres. But in fact, the district owns 10 acres more than that, 2,002 acres. So if we had the acreage right, then our percent ownership would have gone up, which means that our percent profit would have gone up. We recommended that the district determine correct acreages and amend the agreement if necessary to reflect the district's ownership of the lease premises. However, the real estate leasing and support staff and parties decided to leave the ownership percentage unchanged, and upon completion of the mining acreage, WRQ has agreed to convey its parcels to the district. I might be okay with that. I might think that's great. But right now, I would like kind of data attached to it. So if the lease were changed, the lease agreement was changed to 202 acres instead of, and we got the credit for the 10 acres, what's that mean in the lease, the ownership percentage? But ultimately, what I'm after is, what does that mean in money value?
Oh.
And then I'm almost done. I'm sorry, Tim, I know I talk too much, but I'm trying to do better every day. So ultimately, what I'm after is, how many parcels are they going to give us? What is the value of the parcel? And how much money are we not receiving on a regular basis because we've made this decision?
Okay, first of all, let me give you a little background on why it was left unchanged. and based upon doing the audit and discussing this with staff, when they approached WRQ about doing this administrative, basically, modification to the lease, they said, fine, we'll do it, but we'll only do it if you do these other changes too. And those other changes were like not acceptable to us. And so it was better to leave it, as it was, rather than accommodate the other changes that they were wanting us to make, that they were trying to use as leverage to make this change. That's why it actually was not changed.
And we don't have to go through all of it right now, and I'm not saying that was the wrong thing to do. I still would like to see exactly what that means. Because then the question becomes, well, if the number of parcels were not accurate in the original lease, then can they mine those 10 acres? Because I would think that mistake may cause the lease to be not valid, or it certainly doesn't give them the right to mine the 10 acres that weren't accounted for in the lease. You see where I'm going.
Right.
I just don't like things that are like this, and I'm not here to make a decision on my own. I'm just suggesting things that we should consider.
Yeah, I put this slide back up because basically, if you look at what the district owns, TIF owns, and they own, it's like a checkerboard. And so the only way to actually practically mine this was for the three parties to go together, because you can only mine like the entire block. So it really gets down to actually a paperwork calculation, because you can't mine this particular 10 acres because it's all part of one big tract that you have to do together.
Got it.
So those blue areas is what the mining company actually owns. So you really can't just mine part of it. And
No, I already knew that.
yeah.
But the acreage percentage was found to be 5% higher, right?
10 acres.
We can't attribute the size, the additional acreage to exact additional revenue, but obviously it's going to go up, not down. And if it is formal ownership of 202 versus 192, maybe I'm misunderstanding something. The reason that wasn't corrected in the lease is because you said there were other factors that were requested at the time to make that change?
Yes, by WRQ. And those, they didn't go into specifically what those items were, but they were apparently very unacceptable to us. It was very disadvantageous to us.
Got it.
To accommodate those other changes that they wanted. They were trying to use this as leverage to force other changes. So,
Okay, we might want, I would suggest that maybe Paula takes a look at that lease, just from the ownership percentage. Maybe I'm missing something.
I think it's all about just coming back, it's a new governing board, and it's, maybe for me, it's about just understanding what does it actually mean, and then being able to feel confident in a decision based on what does it mean. It doesn't mean the sky's falling. It doesn't mean we're going to change anything. I just feel better making decisions based on hard data. That's all.
okay.
Thank you so much for your presentation. You've exposed us to this almost a year ago. I feel like I was exposed to this early on. And then and now, for some reason, it's just very odd to me that the South Florida Water Management District, no matter what their mission statement is, no matter what our mission statement is doing business like this for profit off the earth. So, it doesn't matter now. That's not what this meeting is about. But absolutely, it just seems, what are the relationships here? What is the history here? What was the money connection here? And are we doing everything right? And it's great to make, of course, the most amount of money, but I don't think this reflects the new governing board. So whatever it is, I am very appreciative of my very brilliant peers sitting to my sides, asking the questions that they are, that we make sure this is just right.
Okay.
Tim, can we, I just need a little bit more clarification. So you and I had talked about DEP and maybe leveraging them. Clearly, they have more at stake in terms of ownership and rights. And I thought you said that the DEP person that you contacted was somewhat in agreement with that conversion rate?
Well, they were in agreement that the standard was an appropriate standard to
At the
apply.
standard, but not the
Right.
the exact, not where
Assuming that the
rate-
standard is appropriately applied.
Okay. So what the next steps then would be to, as we've talked about, get a bid or an estimate on whether that 1.3, is this correct?
Right.
Is the best conversion rate?
Right.
Okay.
And it would require some outside expertise to,
And all we're voting on is looking into the cost, not assigning a contract.
right, this is, because the recommendation is,
Yeah, let's go to that.
see, our recommendation is for management to consider whether they, and we use the word consider, it's not saying they do it, but to go out, explore the possibility, see what it costs, see what it take, and then they can make a decision once they have some numbers to determine whether they, whether it's worth spending the money to get some additional assurance, essentially, is what it boils down to.
Ultimately, here I go, cliche, at the end of the day. At the end of the day, in 2021, we vote on whether or not to allow this lease to go 5 more years. So it's not like we don't have control over the situation. Certainly, I'm not comfortable with anyone doing their own auditing and presenting their audit to us when money is involved. And you're right, we are not the largest stakeholder in this. The DEP is the largest stakeholder, which still comes back to the taxpayer as the stakeholder in a very big way. So I think that I don't need to say anything else. That's what I think. You got it. I'm not comfortable with this. I'm comfortable with what you've done, and I think you've done a really good job. I'm not comfortable with the situation, and I think that that staff now has some direction from us that we want you to look into it a little deeper and then come back to us and tell us that you're comfortable.
We appreciate those. I appreciate those comments. And the other thing we should also say is that we've looked into whether DEP has audited this. My understanding is not. They have not. Now, that's not a rubber stamp, obviously. So I think we're being more responsible from a taxpayer perspective and doing our job doing that. So we certainly have some follow-up items on this. Any other questions, comments from the committee or public comments? None? Okay. So let's call the recommendation to approve the audit of the Lime Rock mining lease agreement, not a recommendation, the audit of the Lime Rock mining lease agreement to vote, please.
I move to approve.
Thank you.
I'll second, please.
Thank you. All in favor?
Aye.
Aye.
Aye. Unanimous, not unanimous, or not anonymous, if I can get that right. Okay. Any general public comment?
Mr. Chair. So I just wanted to point out that that recommendation we are implementing, but we got a lot more out of this discussion to go and look at and bring back to you as well, so we'll do that.
Perfect. Okay. So with that, I'll adjourn. Governing Board workshop is going to be in about an hour today, and then the monthly meeting will be held tomorrow morning at 9 o'clock, right here in the same building. The next Audit and Finance Committee meeting scheduled for April 9th at headquarters. We are adjourned. Thank you.